Uh, Hello everyone, welcome to our channel Vuthela Technologies HD Eswatini. Yeah, in this video we're going to talk about the chart patterns where you need to know and be able to identify as a trader. Please support us, like, subscribe and share our video with your friends and all your loved ones. So this video will cover the following topics. We will look on the chart patterns, rules, the principles to increase profitability, the functions of the chart patterns, the components of chart patterns. Lastly, we will look on how to trade the different chart patterns. So by the end of this video, you must be able to do the following with little or no assistance. So stay tuned. Make sure that you listen until the end of this video. So first of all, we'll start looking on the rules for using chart patterns. Uh, I will say there are 4 to 5 basic rules when somebody is willing to trade with chart patterns. And if you want to trade with the chart patterns, the one and major thing you need to be aware of is you need to use a clean chart. Reduce the number of indicators on your chart, so that you can be able to visualize all the movements as clear as possible. Secondly, you need to trade along the trend. If it is an uptrend, follow the trend. Don't trade against the trend or take small reversals because you end up losing all your funds. Thirdly, learn the psychology of the patterns. So there is definitely no need to memorize the names for all the patterns. But what you need to do, you need to uh, learn the psychology for all the patterns. So it is very, very important that whenever you are trading, you make sure that you have the psychology, the right mindset whenever you are trading. So another thing, be able to spot out uh, the real chart patterns and the fake ones. Just as one is able to detect the or spot fake friends. For instance, you see that this person is not a good friend of mine. This person is a fake friend. So you must be able to detect the fake patterns, because the market is able to give you fake patterns most of the time. So whenever you are using the chart, when you are analyzing, there are instances whereby you will find that some of the patterns in the chart, they are not as good as you think they are. So chart patterns can cheat you just like candlesticks. So you have to be very, very conscious. There are a few tactics you need to follow to increase your profitability. So the duration a pattern takes to form, this really counts. That how long does it take to form or to build the chart patterns. For instance, weak buildings, they take small time to be built, while strong buildings, they take longer to be built. So same thing applies with patterns. For example, one can see a head and shoulder pattern in the 1 hour time frame, and another in a daily time frame. Somebody may ask that which one gonna be good if the both of them they're being compared. So they may look the same, but the one with the higher time frame will work faster, because the stronger the time frame, the good the signal. So make sure that always whenever you are analyzing, you start on the bigger time frame, monthly, weekly, daily, 4 hour, 1 hour downwards. You may find that the whole pair, for instance, GBP, JPY, these days it is bullish. You find that from the monthly, weekly, daily, 4 hour, 1 hour, 30 minutes time frame, the market is bullish. So if you are able to detect that on time, you will be in a good position of starting along with the trend before the market rockets up. Another thing, the size of the pattern matters. Here you may see the patterns on the same time frame, but in this case, we need to consider the one that is bigger than the other. So, and also one that is taller than the other. For instance, we're talking about the doji candle, the doji candlestick. The doji, you may find that it is smaller. The other one, it is a little bit larger. For instance, the other one is a little bit larger. You see, so this one and this one, the their effectiveness will not be the same. So whenever you are analyzing, the price action confirmation should be an ideal. You must add confirmation indicators. You must add some trend lines, momentum indicators. So it must appear at the right place or location. I mean the patterns. It should appear at the right place or location. Some patterns, they need to appear at the end of the trend. Some they need to appear at the beginning of the trend. So make sure that if you identify a certain pattern, you are at a right location or at a very good place. So use volume to see whether the chart pattern is legit or not. Sometimes people they simply place trades because they've seen only one confirmation. So that is very risky. You need to see whether the chart pattern is a false one or a legit one, because the market, I repeat, the market may cheat you, since this system was created to take money from people, not to give money from people. So for you to collect the money from the market, the only thing that you need to do, you have to be very conscious. That is why when you have started to trade a real account, you need to eliminate all your emotions, because emotions, they spoil up everything. They just give you the junk food that you don't need for this long journey of trading. So bear that in mind. So there are some few functions of the chart patterns. The traders use chart patterns to spot entries. Note that when there is a breakout, there is always a reversal or a breakout. You see my chart here on the screen. Most of the time when there is a breakout, you see this rectangle where there is an arrow here. When there is a breakout, there has to be a reversal. So always before you enter the market, make sure that you consider that the late entries will result to great losses, but the early entries, it it is what makes other people to yield more profits. Because if, for instance, somebody from this line has placed a buy, the stop loss will be beneath this support level. So this person will definitely make more profits than somebody who will enter the market later, when the market has moved at least 20 to 30 pips. You see, so another function of the chart patterns, they help us to spot areas of continuation in the pattern. Thus, one can enter in the trend. Sometimes you find that the trend is strictly up, but there are cohesive and passive waves, because you remember the Elliott principles wave. You please check our video in the description below if you still not aware about the Elliott wave principles. So the market, it goes with waves, it doesn't go a straight line. So the chart patterns, they assist us to spot the areas of continuation in the patterns. Thus, one can enter into the trend. Another thing, it prevents one from trading. What do I mean that it prevents one from trading? If the market is not good that day, you see with the patterns that no, today is not my day of trading, then you just stay behind the desk like my desk. You don't trade because if you keep on forcing matters that today I haven't made any money, it's better not to make any money than to lose some money. You see, another thing, the the patterns, they help us to identify where should we take our profits. You see, so in short, I'm trying to bring the picture on your mind. It is very, very crucial and important that you have to know all the patterns, all the chart patterns for you to be able to analyze the market. Because if you're analyzing the market with zero knowledge of about the patterns that have been formed by the market, you may find yourself losing. We do not use the candlesticks for entry, but we use we do not use the indicators for entry, but we use them for confirmation. So it is very, very, very important to note that. For instance, guys, some chart patterns, they help us to determine the stop loss. So, okay, I can mention this thing. You see, if you wanna if you want to, for instance, here you've identified this pattern, you will see that after this breakout, you need to place a buy. And here, after this big reversal, you enter, you close, you enter, you close, and after a breakout here, also you can enter a buy. So in that way, it makes one's life to be easy. So there are these types of chart patterns we will briefly talk about, and after this, trust me, go to your chart, you study, you analyze, you memorize everything, then you go to your demo, try to identify each chart pattern for profitable trading. Trust me, in a space of a week, after memorizing all these chart patterns, you will see results. So we have what we call the bullish chart patterns, which are the ascending triangle, inverted head and shoulders pattern, the falling or the bullish wage, bullish. We also have the pennant or the bullish felt, the double top or triple top. We also have the symmetrical triangle. Um, we also have a descending triangle, the head and shoulders. We also have a rising and a bearish wedge, a bearish flag or a pennant. We have a double or triple bottom, symmetrical. It depends where it appears. So that's why yeah, it depends where it appears. So now let's start with a triangle pattern. So when it appears from a downtrend, it breaks below one can sell. When it appears from a downtrend, like you see my diagram, this is a downtrend, consolidates, then it breaks, then you can place a sell here. When it appears from an uptrend, breaks, you sell. When it appears from a downtrend, it breaks, you buy. That's a triangle pattern. So if you draw this, if you draw your trend lines and this pattern forms, make sure that you observe. Usually, I used to say that people should use the smaller time frame for to confirm their entry. You enter to your second candlestick. For instance, here we are saying it should be a sell. So one bearish candle should form, and the second bearish candle, which is a confirmation candle, should also form. Then you can take a trade. Then there is what we call an ascending triangle. An ascending triangle, it is whereby the market is it's a continuation from a is a continuation of a bullish trend. The market is trending upwards, then consolidates. Thereafter, if it breaks this trend line, you can open your buy position. See, so here, if you are opening a buy position here, you will definitely set your take profit. You will measure this the distance from this from the back of the triangle. Thereafter, you will measure from where you placed your buy and upwards where exactly the point the distance which is the same as the end of the triangle. Also, there is what you call a descending triangle. Note that there has to be a volume spike. So without or a spike, or we can say it's a breakout. So we can consider it as a sell, because this it should be a a bearish market, then it consolidates, then it has to spike here, we consider it a sell. But I advise you, you have to wait for the confirmation candle before you place your sell. So another thing, there is what we call the double tops and double bottoms. You see the double top, this is the top one, top two, the double tops and the double bottoms. This is what we call the neckline. Neckline. Usually, if the market breaks the neckline downwards, it is a very good sell signal. But sometimes the market will break as a false signal and then move uh, upwards again. So usually, when the market is at it has reached this area, the the neckline, there is always, mark my words, there is always a reversal from here up to somewhere thereafter. The continuation of the breakout will then go down. Same thing applies with the double bottom. So there is also what you call the triple top here. The principle is the same as the double tops and the double bottom. So make sure that always you draw the support level, the resistance level, and thereafter from the neckline you must be able to you must be able to exit or enter a trade, or you can just scalp for a short period of time for the sake of collecting few pips through those reversals, especially gold, which is a very choppy commodity. There is also what you call the head and shoulders. This is a shoulder, and a head. Okay, here. Okay, just a recap. If, for instance, you place a sell here, how will you see that your take profit should be? You measure you measure the distance from here up to here, then you place your TP somewhere there, and also here you measure the distance from here up to here, then you measure your TP. Even here, you place your buy. The TP, you measure the distance from one top, the higher top. From here, for instance, it might be here. That's how we see our take profits. So there is what you call head and shoulders. This is a shoulder, a head. Also, is that we apply the same principle as the double top and the double bottom, or triple top, triple bottom. But the only difference is that here, if we wanna measure our take profit, we measure only the head distance from the neckline to the highest market price. Here, that's where we place our take profit. Same thing applies to the inverse head and shoulder. So a safe way to trade the head and shoulders, you trade along the trend. The TP targets measure the line of the head, like I've just explained before. So there is also what you call a wage. What is a wage? A wage, it is something which is called a, like it is a channel. It's not a channel that is not parallel, but it's not even okay. If the channel can go a long way, it can unite along the way. So there is what we call a bearish wedge. It slopes upwards, meaning the market is from being bullish, then along the way at the supply zone, at the supply zone. So the market should go short. You see uh, my first diagram here. There is a if you see something, okay, you draw your resistance level, you draw your support level. If you see a breakout, then you place a sell up there. Also the same thing applies even this side. So there is also what you call a bullish wedge. It slopes downwards. I remember when I first learned forex trading, they told me that you need to buy low, sell high. So the bullish wedge, the market should be as low as possible, and then thereafter, meaning at the head of the trend, the bearish trend. If the market is at the bearish trend, then if you see a breakout after you draw your resistance line or in the support line, that is when you will see uh, good returns after following that principle. So there is also what you call a bullish flag. A bullish flag is like this. A bullish flag is like this. The market will trend upwards, then consolidate, 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 consolidate. At along the price movement, there has to be a breakout to upwards, then the market will be bullish. So it is easy here. If you want to measure the take profit, you measure the the you measure this part from here upwards. That's where you place your take profit. And there is also what you call a bearish flag. A bearish flag, it starts when the market is trending downwards. When the market is trending uh, downwards, and the market is trending downwards, it will consolidate, consolidate, consolidate upwards, which is a false signal. Thereafter, it will rate downwards. You place your trade, and also if you want to measure your take profit, you measure this part, the tail. You measure this part, and then you place your take profit somewhere there. Then you hold until the take profit is hit. There is also what you call pennants. You know, flags and pennants, they look similar, but they are not similar. So bullish pennants, we they will be from volume to the pole. You see, that is what we call the bullish pennant. The flag, they is similar with the flag because of these poles, but they are not similar because the the pennants, they are rectangles with the poles. So if the market is from is trending, is a bullish trend like this, then if you see a breakout here, it means the market is a bullish. But if the market is going down, it will consolidate briefly. Then if once it breaks this support level, the trend will proceed, will continue to go downwards. There is also what you call channels, which are rectangles. Usually other people, they 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 use here they use to trade when the market has retested at least 3 times. For instance, here 1, 2, 3, they place a buy here, and also here is their take profit. if the market it goes with the ranging, the market is ranging, like the market is ranging sideways. Okay, I'm sorry, can I reduce the music? Yes. If the market is ranging sideways, so if you still not aware about how to detect entry and exit points when the market ranges, please visit one of our videos below. We have a video explaining more about how the market ranges. So another thing, there is also what we call other patterns. Other patterns is like the round in both top or bottom, which is it is just like a cup, like this. Here, where here you will place a support, and here there is will be a resistance level, and you will place your buy here, and when the market reaches this, when the market reaches the resistance level, that's when you place you close your trade. And there is also what we call the diamond formation. This is this is when the market is volatile in only in the middle. From the beginning of the trade is not volatile, and towards the end of the trend. So many people, if they when they observe this diamond formation, they place their trades here and their exit spots here. They simply trade what we call the diamond formations. So my last hint is that for you to make it on trading, you need to meditate on your patience, or meditate on your patience from your body, so that you can be at peace and not get into a trade with emotions, because 90% is your emotions, 10% is your knowledge. So if you have more emotions than your knowledge, definitely you will always lose your money. You will always lose your money. Some people, they just rush to trade volatility, the stocks and all everything, like on Nasdaq, finding that they are still failing to master the movements of GBP dollar, Euro dollar, USD JPY, and also the Aussie dollar. You see, like, have the skill, control your emotions. But if you're still failing to control emotions, you control your risk, you you give yourself time in analyzing the market. You don't just rush to make money. In that way, you'll be a profitable trader, and you will thank me. So check our next video on candlestick patterns, where we explain more about the candlesticks. So the video is after this video below, in the link description below. The video is just below. It explains more about the candlesticks. So please like our video, and also subscribe if you still not yet subscribed with us, and also share our video to your loved ones. Please leave a comment below in the comment section that how many patterns have we discovered from all the 12 patterns we've just talked about in this video. Uh, Thank you so much for your time. Thank you for your support. Bye bye.